First of all, I just want to thank everyone in the audience for joining today to hear our discussion on accelerated settlement. On today's panel, we'll talk about the journey of T+1, the implications, and what firms should be thinking about today. We have a great panel lined up for you today to share their perspective on T+1. Starting off, we have John Abell, Executive Director of Clearance and Settlement at DTCC. We have Ian McKay, who is Director of Global Product Solutions at Equilend. And also we have Jeremy Mead, Vice President of Agency Lending at Fidelity. So also, just to let everyone know, we'll be answering questions from the audience at the end of the panel. So please feel free to submit those questions through your proper channel, and we will correlate those and answer those at the end of this session. So before we get started, let's just get to meet some of our panelists today. Hey, John, can you kick us off and give us a little introduction about yourself and your relation to T+1?
Sure. Thank you, David. So like you said, I am an executive director at DTCC in the Equity Clearance and Settlement Group. I've been there for quite a few years. Spent a lot of time working on the U.S. move from T3 to T2 back in 2017. Took a coordinating role in that effort, and happy to now be part of the industry move to T1.
Thank you, John. That's great. Ian, can I get a brief introduction?
Yeah, sure. Hi, my name's Ian McKay. I am the Global Post-Trade Product Owner at Equilend. So I look after all of their products post-execution. So obviously, I've been there for 8 years. Obviously, I was involved in the move from T+3 to T+2 settlement. Obviously, very keen and been involved in the working groups around this new initiative now to move to T+1. Happy to, like John, happy to talk about this today.
Great. Well, thank you for joining today. And Jeremy, can you just provide a brief background on your relation to T+1 as well?
Yeah, sure thing. Jeremy Mead, been with Fidelity Agency Lending since our launch in 2019. I've been involved internally at Fidelity in a lot of working groups on this, and also hosted a T+1 panel for the RMA recently.
Great. Thank you for joining, Jeremy. So as you mentioned, and as the other panelists have mentioned, there has been some previous iterations of accelerated settlement. So the concept is not new. The industry has been trying to shorten the settlement window for almost several decades now. We had the first initial move from T5 to T3 back in 1995. In 2017, we did a move from T3 to T2. And now the industry is looking at moving from T2 to T1 in the year of 2024. One of the interesting things about this is that the U.S. is actually leading the change in driving the shorter settlement to move to T+1, which was actually a reversal from the last time we moved to T2 back in 2017, where the European markets were already moved, and the U.S. was actually a laggard behind in their transition. I guess one of the things I was wondering is the transition from T2 to T1 is expected to reduce the current processing times in half. What are the other major benefits for this initiative and moving to T+1? John, you help answer that?
Yeah, sure. Thanks, Dave. So when I look at the benefits of moving to T1, I really think of them in two kind of buckets. One is risk reduction, and the second is operational efficiency. And looking at it from a risk reduction perspective, I think, the easiest way to kind of quantify the risk is to look at the impact on the broker-to-broker activity or the cleared activity through NSCC. And when we look at the impact of taking a day out of that settlement life cycle, we see a roughly 40% reduction in the value at risk component of the NSCC margin calculation. So that actually frees up tens of billions of dollars back into the members in terms of reduction in margin. There's a kind of a corresponding risk reduction on the buy side where you free up or you eliminate or mitigate some of the risks that buy side firms have to their broker dealers. That's a little more difficult to quantify, but that exists there as well. From an operational efficiency perspective, I think the moving to T1 gives firms an opportunity to move off of a lot of manual processes that exist, to adopt straight-through processing, to move towards industry solutions where industry solutions exist. And if you think about it, adopting these industry solutions and modifying and improving your own systems doesn't only create operational efficiencies for you, but it kind of creates operational efficiencies across the whole ecosystem. So as each firm moves, towards modifying their system, it just improves the entire ecosystem.
Right. Great. Thank you so much, John. Ian, Jeremy, do you agree with the benefits of moving to T+1? Do you see additional benefits? Do you have anything to add?
Yeah, I mean, I would just, to your point, we are sort of, leading the charge this time around, right? And the last time we sort of had a pretty good idea of what to expend, especially in the securities finance world where we deal with other markets. We could see what was happening. This, I think we understand what will happen, right? But we simply just haven't seen it. Certainly agree with John in terms of the automation. I think, if anything, this is certainly going to be a catalyst for the industry to become even more automated. Anybody who is sort of on the fence in terms of some of their processes, this is certainly going to sort of accelerate their decision making or budgeting towards automating some of these non-STP processes, which I think will certainly be a benefit.
Great. Ian, any thoughts?
Yeah, I mean, I'm probably just going to echo a little bit around what has already been said by John and Jeremy there. I suppose when I look at the kind of T+1 initiative, it kind of, whilst it is leading the force in terms of the settlement cycle, it is kind of working nicely with other initiatives that are going on as well. In the fact is that really people are looking to be able to improve the way they are doing their processes. They're looking at the efficiencies. So it actually does tie into probably global strategic views that clients are looking at. I think equally what it also does is it actually probably helps operation teams to be able to have some budget to be able to implement some of these specific changes. And if it is kind of a big industry drive like what's happening here with T+1, that gives a lot of credibility in terms of internal budgeting and being able to actually get some of the enhancements that probably operational people have been looking for a number of years. This actually helps drive that and get this forward. So I think from an operational point of view, it's probably a bit of a blessed relief, and actually can probably get, like I said, some of these improvements and reduction of manual processes that they've been doing for a number of years.
Yeah, and I agree with the panel as well. I think everyone needs to start looking at their budgets now. Maybe we might have missed some of that planning back in 2021 because the budgets already needed to be submitted. But now in 2022 and heading into 2023, it's really important for folks to really start thinking about their budgets and planning of what this move to T+1 is actually going to mean for their firms. Speaking of which, that segues into my next topic. So the move to T+2 was a little over 5 years ago. I'll stick with what do you feel the key differences in this move from T2 to T1 that are different this time around than the move to T3 to T2, which was just 5 years ago? Sure. I'm sorry, Ian. We'll stay with you.
Yeah, sure. So I see the move from T+2 to T+1 as a lot more kind of transformational than probably what T+3 to T+2 is. If you take a look at the timelines between the sale, the broker due date, and also the potential buy-in, they're remaining pretty constant. What is actually getting reduced is actually one extra day of being able to do the processing. So in my mind, what that one extra day of processing actually enabled market participants to maintain an orderly market. They were able to identify risks. They'll be able to issues. They'll be able to manage those and create resolutions and really almost kind of looking to eradicate worst case scenarios where lenders could potentially be moving their portfolios away from lending programs, which obviously would have a negative impact in market liquidity. I think, to maximize the benefits that we were talking about just a minute ago, and also really look to kind of identify negative unintended consequences. I think it's important that we actually analyze the business and technical flows from the beneficial owner through to the agent lender through to the broker dealer. And what I mean by that is that if you kind of take a look at the way the flow currently works now, you've got the beneficial owner who is conducting a sale out in the market. And essentially, they've got to go through a matching, an affirmation, and a confirmation process in regards to that. They probably have some other internal processes that they do as well. But essentially, what they're doing is that they're sending that sale notification over to the agent lender pretty much after the market cutoff time. So one of the considerations there that we need to kind of take a look at is how can we actually improve that flow so that the information that's being provided to the agent lender is actually coming through in a much more timely fashion. So again, taking a look at, is there batch processing? Is there structural changes that are needed? Is there more of a move to a real-time processing that can actually start to notify the agent lenders a little bit earlier? I think equally for the beneficial owners, they come in all various sizes. So some of them probably do have automation at the moment. Others probably need to be able to look to see if there's automation available. And I think it's beholden of the vendors to be able to be looking for offering solutions out there that will be able to accomplish some of those new changes into timelines. If I then take a look at the agent lender, they're obviously getting this information currently now after cutoff time. Obviously, they have to go through a process then of identifying which stocks ultimately need to be recalled and to which borrowers that those stocks need to be recalled to as well. So they've obviously got a process to be able to go through and do that. Because they're receiving that information so late, really the earliest that they're actually kind of giving that information to the broker dealer is obviously on a T+1 basis after the sale. So, already the broker dealer is playing a bit of catch up in terms of trying to be able to cover that position. So again, I think there's certainly some conversations that are being had around, well, actually, what is the benefit of being able to extend the current market cutoff time? And again, also looking to see if there are automated ways of being able to notify the broker dealer of the recall notification. And then also, again, I think that's an obvious one where you kind of sit down and take a look at the communication flows between the agent lender and the broker dealer and saying, look, is there automatic ways that those recall notifications can actually take place, and actually look to be able to streamline that particular process there, not only at the execution level, but also then downstream in terms of actually getting that instruction out into the marketplace. And then I think finally, if you kind of look at it from the broker dealer perspective, obviously from their point of view now, they're receiving this information on a T+1. Currently, they're going out, they're looking to borrow the stock, they're looking to cover the recall. They had the luxury of that additional day. They don't obviously have that now. So from their perspective, what they need to do is they need to be able to get that information earlier. Obviously, they would like to be able to get it into their optimization tools, which happen overnight, so that they actually are in a pretty good position at the beginning of the day to instantly know what they may need to source or what they can actually cover naturally themselves. So from that perspective, they're obviously looking to be able to see if they can get some kind of an extension to the current market cutoff times, and obviously a little bit more automation in terms of the notifications around the recalls, so that they could then go out and actually borrow the securities. And again, I'll come back to the constant theme around the fact that, for the borrower or the broker dealer, what they need to do is they need to go out and borrow the securities. They need to be able to get that securities executed in a timely fashion, but equally they need to be able to get that instruction back out into the market again. And I know I spoke about this a little bit earlier around some of the constant themes that are going on with other initiatives that are happening around the globe. This is probably the constant theme, and the fact is that the latency between an execution and actually getting that instruction out in the market and settling it is becoming more and more crucial, and it's becoming more and more condensed. So I think, to summarize, what essentially people are looking at is they need to take a look at the process flow kind of horizontally, completely from beneficial owner through to the broker dealer, but then equally from a kind of vertical perspective internally in their own shops, they need to look around how they can eradicate some of the latency that takes between kind of executing and settling the transactions, so that inventory can move in a lot more of a seamless and timely fashion than what currently happens.
Yeah, thank you, Ian. Obviously, there's still a lot of manual processes around the notification process and additional coordination with borrowers and lenders and working out that workflow with third parties and agency lenders is definitely something, an area to dig down on. Jeremy, as an agency lender, do you have any other kind of considerations in moving to T1?
No, I mean, I agree with everything that Ian said, and I was going to touch on it in a minute. But yeah, it's certainly that information lag, right, between beneficial owner and ultimately the borrower. And while our 204 isn't necessarily changing, we're still working on an S+3 basis, which is good. Ultimately we're in a T+4 world instead of a T+5. So everything just gets just truncated. And I certainly agree that the move from T2 to T1 is going to be more impactful as a result than it was from T3 to T2.
Thank you, Jeremy.
I think Ian said it pretty well.
Well done, Ian. And I guess, John, at DTC, anything we should know about, and anything that
I would just say, and it's kind of similar to what Ian said, but really, when I think about exceptions, and when we went from T3 to T2, there was still some time to manage exceptions. We compressed that time, but there still was time. When you go to T1, you've all but eliminated any opportunity to manage or to resolve exceptions. So I think it's kind of key for firms to understand why these exceptions exist, take a look at their processes to find out why transactions are failing, why things are breaking, to put in kind of holistic solutions, look at industry solutions where they're available, adopt those, and look where you can eliminate exceptions going forward instead of trying to manage them, because there just won't be enough time to manage them.
Yep, very important. I think those terms and lags and execution and getting things done, a lot of those lags are definitely due just to exception processing and resolutions, sending emails to the counterparty, waiting for them to pick it up, waiting for them to confirm back, waiting to send an email back, waiting to do the inputs to do those resolutions, and moving from an exception-based world and now moving from T+1, and like you said, John, really looking to move towards an elimination world and figuring out why we have those exceptions and getting rid of those so we can ultimately stop that latency in that STP processing. As the U.S. is moving to T+1 ahead of Europe this time for the T2 to T+1 transition, Jeremy, what are some of the biggest risks and concerns you have moving to T+1? Again, keeping in mind the international landscape and the potential for market fragmentation.
Yeah, and I think I may just echo a little bit of what Ian said. In the beginning is obviously we talked about the information lag, how to a large extent obviously in DTC we're working in a T0 environment, right? But on a recall front, we're still very much working in a T+1 in many cases. Even if you have a beneficial owner, if you're an agent with a beneficial owner with real-time sell notification, right, which we're actually fortunate to be one of. That 3 o'clock cutoff still means you still have an hour in the U.S. trading day where something could be executed, and you're automatically T+1, right? Now on top of that, like Ian mentioned, you could recall that effectively the following morning. A borrower doesn't really use their optimization tools until 10, 11 o'clock p.m. that next day. Now you're talking about T+2, right? So while we say T+1, in reality, it's T+2 in a lot of cases. Even if something was sold at 10 a.m., you recall it at 11 a.m. You're still talking. Now you're talking T, but in reality, it's T+1. So extending that cutoff, I think, is going to be crucial. Crucial for this whole thing to work. all participants are just going to need to embrace a real-time method of communication flow. And I think to a great extent, borrowers are using tools like Equilend and ARMS to accept the recalls. But again, how do we act on those and execute them in a way that we're not putting stress on S+3? Because we all know how that goes today. It's just not it's not ideal to let it go that far. Recalls, reallocations on the agent side, that's going to be an even bigger part of the equation as well, right? What can we do as agents to cover short exposure on the day that it happens without also relying on recalls and putting technology in place to better communicate with borrowers when these reallocations occur. I know for us that can be a challenge, and now you're talking about contract compare breaks and whatnot. So all of these things put together are going to be important when talking about condensing this market. I'm sorry, condensing the settlement cycle. With regards to international, right? We haven't seen a lot of movement towards T1 in Europe and APAC yet. We have seen, chatter about that in Canada and Mexico. Europe, I don't suspect we're going to see anything until, so the dust from CSDR settles a bit. But working in two different settlement cycles, again, I think we're somewhat used to this. 5 years ago, we were certainly in a world where U.S. was kind of the outlier compared to the rest of the world. But certainly, I think it is coming. But we're all going to have to be cognizant of the fact that we're dealing with different settlement cycles.
Thanks, Jeremy. How about Ian?
Yeah,
biggest risk and concerns.
I was going to say I appreciate the fact that there's some potential market fragmentation in terms of the actual settlement cycles, but I still think that some of the principles are actually remaining the same in terms of some of whilst the drivers may be different, the principles are the same. I think equally in Europe there is a lot of focus in ensuring that reallocations are transparent. And that the borrower and lender community are matching their positions. They recognise the importance of the returns and the recalls as well. I've had probably more conversations with clients about recalls internationally over the course of the last, I would say, 6 months than I've probably had in the last 7 years or 8 years at Equilend. So I think that whilst like I said, some of the drivers may be different, the actual focus and attention on the pain points actually are quite maybe worryingly similar, because it looks like we have a global issues that we need to address rather than specifically regional ones. So I think from that point of view, good order in terms of maintaining your book. I think what we are seeing, and we've certainly seen this, there's more looking at the books, making sure they're in line. There is certainly more attention paid to pre-matching as well to ensure that the trade is executed correctly. There is more emphasis being placed on mismatches, and I know this was something that was brought up in a panel earlier. What we are also seeing is that clients and counterparts are taking a look at the interactions between each other, and actually where there are potentially some clients that are more automated, have a better SDP process, then actually what you're finding is that they are inadvertently starting to get probably a little bit more business coming their way, because there's a bit more of a comfortable confidence level in the fact that the instructions are going to get processed correctly first time, and they're going to settle. But I actually just think that those behaviors are just going to accentuate more and more. And actually, hopefully what we will find in something like Europe is that CSDR, for example, actually helps make the T+1 transition a little bit more comfortable than potentially what it could have been.
Thank you, Ian. John, any risk?
Yeah,
coming from DTC's perspective.
Yeah, I think both Ian and Jeremy did a pretty good job of talking about, the impacts of being out of sync, right? Of the U.S. being T1 and Europe continuing on T2. We know, we work closely with the Canadian market, and we know that, Canada is going to move to T1 at the same time as the U.S. It's our understanding that Mexico will as well. I know when we went to T2, a lot of the South American countries came along at the last minute. So, I think that's being looked at there. I think it's safe to say at this point, even if Europe was to make a decision to move to T2, they probably would not do it at the same time as us. It would be sometime, further down the road. So there will be a period of time where the markets are going to be out of sync. And like Jeremy said earlier, that has happened before. In fact, Europe had moved to T2 3 years before the US. So, it's a considerable amount of time. It's probably time to, dust off those procedures and understand how we managed that last time around. I think another area that probably warrants looking at more generally, I guess, in the US market is institutional trade processing. And there is a lot that has to happen between the end of trading and the beginning of settlement, and that's particularly true in the institutional trade processing. So, there's some pretty rigid cutoff times. This is a 7 o'clock allocation, 9 p.m. affirmation. That's some aggressive times in that space. So it's probably another area that's worth looking at.
Certainly. And thank you, John. Moving on, the move to T+1 is being broken down and looked at through a couple of work streams and a couple lenses. One of those lenses, as I think even Ian alluded to, is behavioral changes. Another one is technology changes. And then actually the third lens is the non-technology changes. I guess from this, folks, in your opinion, what do you guys think the move to T+1 is? Is it more behavioral? Is it more technology? What are your thoughts? John?
Sure.
We'll lead off with you, John, again.
Well, I'm going to take the easy way out, and I think it's a little bit of both, right? So if I look back at what we did when we went to T2, I think that was really behavioral changes. I don't think there were, big, huge tech changes that were required. I think it's a little bit different here, right? I think there are, batch processes and manual processes that just have to change. So I think there is a certain amount of tech work that's going to have to be adopted. I think there's a fair amount of behavioral changes too. I think a lot of I'll say the problems that we have are self-created problems that we've put in place as an industry. So I think, a lot of those need to be relooked at, and they are being relooked at. There's a lot of work that's been done around things like the stock loan recall times and, trying to make that fit, or prime broker disaffirmation, or a number of different other topics that, are just processes that have evolved over time and just need to be reevaluated to see, how do they fit, or how do they need to be changed to support a move to T1.
Yeah, I mean, I agree with John. It certainly is both. I think it skews a little more on the tech change. And it's not even necessarily new tech, but really embracing the technology that we already have, and for a lot of firms to be able to plug into it, right? I think the tools are there to a large extent. But embracing automated recalls, embracing swift notification, using the tools that vendors have available to make this process smoother. On the the personal front, right? Maybe part of it is a psychological change, right? Now we just have to switch our minds to one day sooner. But it's also doing away with any sort of manual process that we've all maybe just become comfortable with over the years, right? And really sort of taking a fresh look at everything that we do. Is this something that is the most efficient way to do it? Because, maybe small things here or there, in isolation doesn't have a big impact. But when you take a fresh look at your front to back processing, how you're getting notification, or how you're receiving cells, how you're communicating, how you're issuing information out to the street, these things, and little by little is going to make a big impact.
Yeah, absolutely agree, Jeremy. The manual process that exists today. But what would you say to I guess just one follow-up question about the manual processes and automation, but what would you say to some of your smaller mid-sized clients who don't necessarily have the budget or don't necessarily have the amount of volume to invest in a full system to be fully automated? How would you how would you manage that client relationship, and what would you look to do to kind of make your operations more efficient in that sort of scenario, knowing that, budgetary constraints. Not everyone has the big pot of gold where they can do whatever they want and get everything they want. So, how does that fit your business as well and overall planning?
Yeah, I think we mentioned it before, right? I think this truncation, right, is sort of the catalyst that is really going to make everybody have to look critically at their processes, right, and sort of reevaluate their budgeting and reprioritize a little bit. Obviously, we can chat about T0, right, but this is sort of the train stop on the way towards that, whether or not we get there or when we get there, right? But the last thing anybody would want is to sort of be left behind. And I think these larger industry changes, it just sort of makes everybody have to get more efficient. And I think we've seen this before, right? When we move from T3 to T2, or whenever there's sort of an industry change, sometimes you sort of think, the sky is falling and it's going to be chaos, right? But everybody tends to just get more efficient out of necessity. So while, some firms may, it may be a bigger leap to adopt some of this. At some point, I think you just have to look critically and reprioritize a little bit.
Jeremy, I have a quick question, actually, if you don't mind me just jumping in. Sorry, David.
Sure.
Do you reckon that stable portfolios are likely to become more widely used than more volatile ones, just because of the nature of the move?
Mm-hmm. I mean, absolutely, right. But I think it's ultimately going to be available supply, right? I mean, I think warm to hard to borrow names are going to be warm to hard to borrow names, and those are going to be utilized regardless of where they are, whether it's coming from sort of a stable supply or less so. I think in general that stable supply will, this is going to increase its attractiveness just because of the lesser likelihood of going through this recall process. But like I said, at the end of the day, what's available is what's available.
And again, David, that kind of again leads on to or follows on from a panel discussion that was had a little bit earlier around liquidity, and actually what they were taking a look at was the operational costs associated with a transaction. And I think generally what we're certainly seeing is that firms are getting better transparency around the costs of doing the trade, and not actually what the cost of borrowing the stock is, but actually what the cost is of actually being able to process that, the inefficiencies, how much is a cancel and correct instruction cost, and so forth. So actually what they're looking to do now is obviously bake that in. So, when previously before, if you kind of saw that kind of steady supply, all of a sudden now they become attractive because actually, people are beginning to realize actually how much that additional cost does come in to be constantly churning through positions on a regular basis. Now they realize that actually it is quite a costly process. And I think that a lot of this is down to the fact that firms are having to get more transparency around the inefficiencies of their processing, and also how much it actually does cost to be able to do a transaction.
Yeah, those are all valid, very, very valid points, Ian, and that's something that we look at as well on the brokerage side. And again, on the consultant side, we are always working with the operational executives and ultimately trying to get a true understanding of what that cost is to process a trade. And obviously, budgets constraints and resources being short, that cost pressure is being felt across the industry as a whole, and really trying to get an understanding of that and control around that as well. We actually have a question from the audience, and it's related sort of to outside events and unexpected events. So the question is what is the impact of international events like Russia-Ukraine war? Any impact on the SEC lending or any preparations to be done? So this probably goes all to the line of resiliency around SEC lending and what happens when collateral has been borrowed and trying to get back and sort of an unexpected situation, one of these unexpected events should happen. Any thoughts, Ian or Jeremy?
Well,
yeah.
Go ahead, Ian.
I suppose if you take what we have seen, and I suppose if we kind of go back to maybe market volatility, what I probably have seen over the course of the last couple of years is that you've seen a tremendous amount of volatility going on in the market, and from that point of view, I think that the requirement to leverage off technical solutions has become more and more obvious. And actually, I think without blowing our own trumpet, I think that we've done a pretty good job in being able to help support those pretty stringent market corrections. So I think from that point of view, yes, admittedly, that there is a lot of work that needs to be done, but I do think, as Jeremy alluded to earlier, there is technology that's out there. I think the technology firms have spent some time to interconnect with other technology firms. There clearly is more ways to go in regards to that, but what I do think is that it does allow for a streamlined process from end to end or point to point, which actually does help to be able to manage kind of extreme market volatility and still maintain that SDP processing that people expect.
Yeah. And just to bring that back around to T+1, right? Obviously, where we have volatile markets such as recently, if we take today's environment, right? Take one day off. We're extremely busy on the sell and recall front these days. Now just really double that in terms of its urgency. So it's again, tying into these systems and the automation is going to be even more critical the next time this happens.
I think the only other thing that I would add on to the question earlier was, that as we go through these kind of changes, we have to just kind of make sure that we're kind of always covering off all of the potential unintended or unknown events that may hamper or be involved in the process flow. I know there's been a lot of work done with the working groups, and they've spent hours and hours and hours actually going over these as well. So I do think there's been a lot of focus and attention applied to those. So that there's been some great work that's been done there. But I mean, if I take a look at one of the examples of CSDR, for example, here, there is an emphasis around doing a lot of either same day or very short borrow cycles. I think the realization around how important collateral moves associated with that as well, and the importance of being able to manage your inventory really in an efficient manner, to be able to know instantly where your inventory is, being able to access that inventory instantly, has really been heightened. And I think that, a lot of work and time and effort has been put in by the market participants to really start to take a look at inventory and manage inventory differently. So I think if you kind of take a look at, some of these initiatives that are going on, I do think actually, getting that kind of awareness around that, and actually, some other kind of priorities and initiatives crop up as a consequence of some of these changes, that's where it ends up being the kind of focus and attention it starts to get applied.
Yeah, absolutely. And it's critical now for real-time position management and knowing where your firm is and know what's available, again, to borrow and to be able to lend, and starting to get more real-time information, and then using that real-time information to make better business decisions, and really unlocking the data across the firm, and moving from batch from what we're doing now, again, to those more real-time funding, cash flow management, and forecasting and predictability. With that being said, I know we'll be talking about T+1. The evolution of T+1 is, of course, T+0. As you know, the SEC came out with their comment. They basically came out with their rule proposals back in February of this year. Within it, they had a lot of interest of what it would take to move to T+0. What the implications would be, and how much it would cost. So with that behind, sort of setting that background behind, what do some of you think about a T+1 model in the future? And, how long do you think it'll take for us to get there? I know, John, maybe John want to kick this one off since you have a lot of initiatives around T+0 with your Project Ion and those initiatives that you're doing, those proofs of concepts, and as well as sort of a MVP product launching around that as well.
Yeah, sure. So, I think it's probably worth spending a second just to define what we mean when we say T0, right? Because there's a couple of different ways of looking at this. And, when you say T0, some people naturally think, real-time gross settlement, the settling of literally, hundreds of thousands of or tens of millions of trades, every day, and what's the liquidity implications of that. And I think, the industry quickly comes to the conclusion that that's probably not the best model for us going forward, and that we're probably looking at some type of, intraday netting, whether it's, multi-batch netting cycles throughout the day, an end-of-day netting cycle, whatever that, tends to be, but real-time growth probably isn't the solution. We did do a fair amount of work looking at T0 when we did our T1 analysis and kind of came to the conclusion that, it's probably too much at this point in time, and that, T1 is a much more doable, achievable, initiative, and that's where the industry elected to focus its attention. I think what we'll probably see at some point is we'll see a need to do a true cost-benefit analysis of T0 to really understand what the impacts are and what the benefits are. So, we did a high-level analysis, but I think there's a need for a real detailed analysis. I think that's something we'll probably see. I do think, although we might not see, the industry adopt T0 as a standard settlement cycle in the near future, I do think that we may see areas where T0 becomes kind of the optional settlement cycle of choice. So there will be exchanges or trading platforms that will be standing up T0, trading venues that people may opt to take advantage of. So as we modify our systems in support of T1, we're also having an eye towards T0, recognizing that we'll probably see some of it in the short term. And to your point, it does seem like the obvious destination. It's just really a matter of when.
Thanks, John. And Jeremy, so move in the context of John and moving to T0, what does agency lending look in a T0 environment? Does that business still exist? What are your thoughts around that? And I'm interested to hear, because this is an open question that I have, and
we're still trying to get our head around T1, right? T0 makes my head want to explode a little bit, right? But I think it's difficult to comprehend exactly how T0 would look in the agency securities lending world, right? And I think just as a finance industry, right, lending would probably be the total afterthought, right? How this would look. I think at that point it's sort of all of the technology that we're talking about on steroids a little bit, right? I mean, this would have to be, forget T+1 recalls, forget, we're going to have to operate, on T really, provided that, the regulatory environment wouldn't change, that we would still have 3 days on the back of an actual fail to have shares back in time, right? I think we would certainly need that. But really, it's just a severe continuation of this conversation that we've been having. It feels like when we started from T3, right, it just, the consequences get higher and higher, sort of exponentially so as we march towards T1 and eventually T0. So I wouldn't say it's fundamentally anything different, albeit a lot more of it.
Thank you, Jerry. And Ian, your thoughts as a
Yeah, I mean, one of the answers to my questions earlier, I mentioned that it was transformational moving to T+1. I think moving to T+0 would be, to Jeremy's point, kind of a little bit out of this world. But I do echo to a degree with what John said earlier. Netting is crucial. People are concerned about the fact that there will be that hundreds of settlement will be at gross. So this netting question certainly needs to be the one that people need to get comfortable with as they kind of analyze the process of moving to T plus or T0. Sorry, I think the other thing also, which kind of follows on a little bit from what Jeremy was saying earlier, is that we've spoken about the kind of technology changes that would need to be able to accommodate a T+1 process. I think probably moving into that kind of probably T0 would end up being something around digital movements. Inevitably, that's a pretty big quantum leap. And so I think what firms will end up doing is actually having different architecture that would inevitably be able to support that, which I think kind of aligns with what John was just saying around you'll end up finding different exchanges or different ways of being able to maybe enter that exchange as well. But the fact is that there'll probably be a separate environment that's able to be able to support that. I think equally everyone's probably having conversations with different areas within their client base around what that world looks like and how that actually could be managed. I think that it's really at the embryonic stage, and really people are trying to work out what the kind of user case will be that will actually generate something tangible that everyone can go, actually, this does do what we've been saying it's been hoping to do for a kind of number of years. So I think that it is at early stages. But once you probably do get a little bit of a kind of an awareness around an area that people can focus their attention on, then I think you are going to see some quite quick movements, because there certainly seems to be a lot of investment coming in from our client base. There's certainly a lot of budget in there from our clients as well. And I think if you take a look at the regulatory drivers, we've spoken about the fact that managing your inventory is going to be crucial. You've spoken about the fact that you need to eradicate the latency. That kind of digital processing is obviously one of the biggest benefactors is being able to achieve both of those goals. So I can see why people want to be able to achieve it, but it's still got some work to do.
Thank you, Ian. All right. Well, thank you all. Let's just have a quick wrap up and talk about accelerated settlement. So I guess quickly, your 10 your what is it, 110 character closing final remarks on accelerated settlement, and what firms should be thinking about and what should they be doing today. We'll kick off with John.
Yeah, I mean, we're talking about 2024. We don't know the exact date in 2024. That'll come out from the SEC, but it's somewhere in the neighborhood of 2 years away. That's not a lot of time when you think about the amount of work that needs to be done. So, certainly it's time to get mobilized, start looking, putting together internal, project teams, to start looking at T1, start defining what your requirements are, start securing financing. We like to think of 23 as kind of the year of the build. So, get all your prep work out of the way this year. 23 is build, 23 is internal testing. It's going to be probably a 9-month test window at the industry level. So that'll hopefully be the early part of 24. And if everything goes as planned, we'll see implementation in the third quarter of 24. So a lot to do and not a long time to do it.
100% agree. Ian, closing thoughts?
Yeah, sure.
What clients these days?
Yeah, sure. Look, this is obviously the step in the right direction. The benefits are being outlined, certainly from the risk perspective. Clearly, there's also going to be operational benefits that will come from this. They're much needed. And so when John's kind of saying get your budget together to be able to sit down and kind of and manage this, I think that A, you've got something pretty good to help you get that budget. But B, I think really what this is going to start to do is iron out some of those annoying creases that you've had in your processing over the course of the last number of years, and actually achieve some of that kind of SDP processing and reduction of manual processes that you've been craving for as well. So I think that, from that point of view, you should be really kind of looking to embrace this, actively working with the working group to be able to drive this initiative forward, and then really, I suppose, keeping everyone, including the vendors and everyone associated with this, feet to the fire, so that they can deliver against the milestones and ensure that we execute a timely delivery in regards to this initiative. So I think we should fully embrace and support this.
Yeah, absolutely. So, I mean, the T+1 is not solely an operational problem. The business really needs to come in and understand what the impacts are going to be, and they really need to be communicating with the rest of their operational and technology teams to make sure that they're all aligned, because clearly T+1 is a very large initiative. A lot of processes are going to change. It's going to touch every aspect of every firm, and really those friction points now that are sort of dealt with and never really fully cleaned up, and just sort of kept on being managed on a one-off basis and never really understanding the root problems. Those type of situations, really now firms really need to dig down, stop doing the deep analysis, and really start getting to root causes of those, and start putting the solutions, whether it be behavioral changes or whether or not to be technology changes that help enable them and give them fully greater STP. Jeremy, final thoughts before?
Yeah, again, I think everybody just needs to analyze where the lag is in their communication chain, whether you're a provider of recall information or a consumer of it, right? And also embrace these industry groups to come up with a consensus, especially around recall timing and consumption of these messages, and how we can make this more efficient for everyone.
Great. Thank you so much. I just want to say thank you, John, Ian, Jeremy, for taking your time out today, spending the time with the audience as well as myself, sharing your perspective on T+1. It was very insightful to learn from you, to learn about what the challenges be, and what the clients should be focusing on and putting their attention in, not only from a firm, but also where everyone needs to understand an industry and how to work better, and have better coordination between all the parties involved in within the industry. So thank you for your time today. I really appreciate it. And to all the audience members, thank you. Have a great day.